Welcome to this animation on the profit and loss account. The profit and loss account has many names, but most of the time you will find it named as P&L, profit and loss, or income statement. Regardless of the name, the P&L is a summary of the results of a company's operations over a particular period of time. It shows us a breakdown of a company's sales and expenses. It's like a film of the activity of the company in a given period of time.
The P&L is as simple as sales minus expenses. If sales are larger than expenses, we will obtain a profit. But if sales are smaller than expenses, then we will suffer a loss.
Normally, the first thing we find at the top of the P&L is sales, or the company's revenue. Here we have the amount of money corresponding to our sales, and we call these figure gross sales. But we can often see some discounts. These discounts can be on invoice or off invoice. Once we deduct the discounts, we obtain net sales.
Then comes COGS, or cost of goods sold. This is the cost of the goods we are selling and has a direct correlation with the sales our business has made. It's the money we have spent to buy raw materials or the labor direct costs to manufacture the goods we sell. Some companies differentiate COGS into two concepts: manufacturing and logistics. Manufacturing costs include both material cost, ingredients and packaging used in the production process, and finished goods purchased externally for resale, and industrial costs, all costs associated with the manufacturing process to produce goods for sale. The manufacturing process begins with the materials picking and ends when products are available for sale. When we take net sales and deduct the cost of goods sold, we obtain gross profit. Gross profit will help us analyze the efficiency of our production and sales process. Gross margin is the percentage representation of gross profit to sales. Once we have gross profit, we will deduct sales, general and admin expenses, or SG&A. This includes all expenses related to selling our products, such as brand investment, media, point of sale material, promotion and events, etc. General and admin refer to all the overheads, such as rent paid for the headquarters, insurance costs, supplies, IT equipment, or indirect staff such as legal, finance or HR departments. Gross profit minus SG&A will give us operating profit, which is often referred as EBIT, or earnings before interest and tax. Once we have reached EBIT, we need to deduct, or add, the financial results, also called interest expenses. We also need to pay government taxes. This brings us to net profit. This is often called bottom line. Net profit will have two main destinations. Either it is paid in dividends to shareholders, or it adds up in equity in the balance sheet. Let's see an example. This year we sold pet food for €625,000, but we have made some discounts. $20,000 on invoice and another $5,000 off invoice. So we have net sales for €600,000. The cost of raw materials, factory salaries and other manufacturing expenses has been $300,000, and another $50,000 correspond to logistics costs, obtaining a gross margin of €250,000. If we deduct advertising and promotion for $70,000, we get brand contribution of €180,000, and after deducting overhead costs we obtain earnings before interests and taxes, or EBIT. If finally, we deduct financial result and taxes, we'll obtain net profit. Thank you for watching. See you on the next video.